All right, welcome to our third Thursday webinar series. I'm Scott Caskey, a certified financial planner with Summit Investment Advisors. Today's webinar will be keys to investing for retirement, and I will be the organizer for today. I have a few housekeeping items I'd like to touch on before we start. On the right, we have a control panel, and the orange button will toggle the control panel back and forth. You'll use the control panel to ask any questions you may have throughout the workshop, and we'll be trying to get those answered quickly throughout the workshop. Below that, there should be a section for the handouts, which you can use to follow along with the presentation. We also have an evaluation form that we would like you to complete at the end of today's webinar. Our speaker today will be Nate Krampe. He's a certified financial planner and the vice president at Summit Investment Advisors. He specializes in working with retirees in the medical device industry. Nationally recognized in the Wall Street Journal, as well as Minneapolis-St. Paul Magazine and Minneapolis-St. Paul Business Journal, has received the 2015 and 2016 5-Star Wealth Manager Award and has been a 10 years experience as an investment advisor. And with that, Nate will start the webinar. Thank you.
Well, great. Well, thanks, Scott, for that introduction, and thank you, everyone, for attending the webinar today. We have a lot to talk through today, and really I wanted to start with kind of talking through what we're going to cover, and then kind of start in on the individual pieces of that. So what we're going to be covering today is some of the foundations of a good retirement. Another way to look at things then would be to considering your income expenses a little bit like a corporation. So we're going to touch on that. We can't get away with a webinar without touching on diversification. And then we're also going to talk about an income plan as well. So that's really where we're going to be going today. Now, with that, I wanted to start today out with talking a little bit about this woman, Yuta Pippig. Now, just to kind of give you a little bit of background about Yuta and how I came to know her. I don't know her personally, but just kind of know her story, I should say. As some of you may know, I'm a runner, and I like to run and actually enjoy getting out and running. And I do marathons every once in a while as well. Now, with that, my key way to train for a marathon basically is to say, let's sign up for the marathon, one that maybe is 9 months or a year out from today, and then that just gives me the motivation to actually train. So usually I need to actually sign up for the marathon to train, and that's something that has been motivational and inspirational to me to have that going, so I have that end goal. Well, sometimes I need a little bit more motivation than that, and that's where I found Yuta and some of her motivation. Now, the story of Yuta is that she is an elite marathon runner, and in the 90s, she was actually at her prime and was running a lot of marathons, and in 1996, she was going for her third consecutive Boston Marathon win is what she was trying for. So she had already won twice, and she was trying for a third time. Now, this particular marathon was pretty devastating to her, and she had cramps, she had bleeding, she was bleeding, I should say. She had some intestinal issues, and she was miserable and was not having a good race, and definitely was not, um, not functioning well. So she was falling behind, and the leader at that point in time, and let me get this correct, her name was Tegla Larope, and she was a Kenyan who was roughly about 250 yards ahead of her with about 5 miles left in the race. And for those of you who know running or even biking, that's a big distance. That's about 2.5 football fields, and to really make up that amount is nearly impossible that late in the race. Now, Yuta had kind of a plan in place though, and she started implementing that plan every single step that she had from there on out. And even though she was in pain, even though she was suffering, she started to close the gap on the Kenyan, and ultimately she won the race. Now, willpower doesn't even begin to describe what she has been going through and what she went through in this race. So it gives me some motivation there that putting a plan in place, her implementing the plan, she actually won the race even in spite of some hardships. And that's a little bit like investing. Now, with the recent volatility that we've had, it's easy to say, let's quit. And Yuta could have quit her race as well, and no one would have blamed her. People would have said, you know what, you can come out next year, you can do better next year, that's fine. In the same way, no one would blame us for quitting on the stock market, for saying, you know what, I want to not be invested. I want to sit on the sidelines. I want to sit in cash. I want to wait out this volatility. People would say, you know what, that's fine. Let's do that. Well, Yuta did not quit, and she ended up winning the marathons. Now, I tell that story just as kind of, like I said, a little bit of motivation, but also what I like about marathons is that there's distinct phases that we need to plan for. And part of that plan then is to say, when we're training, how fast do we need to go? And what's the course like? Because if we train for a very, very flat course, but it's incredibly hilly, that's the wrong type of training that we have done. On the flip side, if it's a very, very hilly course and we've trained correctly, that means that we have that much more reason to be confident in our abilities there. So we can train for a race, and all that comes back to our preparation work. The same thing is true with how we invest as well. And the training that we go through is training for retirement. That is coming back to what you see in front of you here, the slide that says, well, how much do we need for retirement? If we need $5,000, maybe $10,000 a month, I'd like to think in kind of terms like that because it helps me understand. But for some of you, you may want to think in terms of lump sums. So do we need $1 million or $2 million lump sum amount so we can have the money available in retirement? That comes back down to our planning. And prior to retirement, we start putting some money away. That's part of our training. We start putting a budget in place. We start sticking to the budget. That's how we can train for the race that is retirement. Well, that's not the only way that we can train for it and prepare for it and have a plan in place. There's a second aspect as well. In running a race, it's not enough to know the speed that we need to be going or the course itself. Is it hilly or flat, or do we have a lot of turns and curves that we need to go through? We also need to know the distance. It's really going to be a hard thing to do if you want to run a race and you have prepared for a 3-mile race, but the race is 10 miles long. Or on the flip side, if you sometimes be prepared for that 10-mile race, but it's only 1 mile long, well, that changes your speed that you're going to need to be going in order to keep up with things. So we need to prepare for the distance of retirement as well. And the word and term that we use is longevity. So how long do we see and foresee retirement lasting? Do we see it for 5 years? Well, in that case, then we're going to plan for money a little bit differently. But what if it's 20 years or 30 years that we need to be planning for? That's the differences that we need to work into the plan so that we know how to run the race of retirement correctly. Now, I had a video that I wanted to show, and it ended up being that the webinar couldn't really play it very, very well. So I am going to put it in kind of a final version of the webinar. So when you go back and take a look at it, you can see it, as well as I'll send you the video after the webinar as well. But the video was really nice and distinct, going through just the fact that there's a lot of people that are retiring right now, that some of them do not have a plan in place, and how to go and implement that plan. But the last aspect of it, the one that I really thought was very kind of indicative of what we're talking about here, was the last sentence. And it said, remember, you can't win if you've taken yourself out of the race. That is what we want to talk about more. So that plan in place is the foundation of what we're talking about. And if the market volatility has pushed you to the sidelines, come talk to us. We want to be here to help and talk through and put together a plan for the future. Now, when I started looking into a little bit more, I just had some fun with this and wanted to know of how many actual websites there are for just that, how to run a marathon. And if I did a Google search, I found 102 million pages dedicated to how to run a marathon. That is a lot of pages, and some of them are dedicated to just what you're eating. Some want to give you a plan to say, here's what you need to be doing every week, every month in order to run it. Some will even talk about the shoes and the clothes. Well, that's a lot of pages dedicated to running the marathon. Also, I want to do the same thing with investing as well. And with investing, I found well over 170 million pages dedicated just to investing. And this can be all sorts of investing that we're talking about here. So anything from just how to pick a stock or bond, or diversification, or where we should be going into right now. And that's enough. But let's put this into context a little bit. As of last year, 2014, there was roughly about 320 million people here in the U.S. Now, the statistics say that about on average, 48% of Americans have any investment. So that would be, just even say $1 in a stock would constitute an investment in their eyes. So 48% of Americans have an investment. That comes out to be roughly about 153 million people in the US have an investment. Well, we have 170 million websites dedicated to investing. That's more than we actually have investors. That's a huge deal, and all of these websites are good and are needed and help, but sometimes there's too much information out there. That comes back to, what is the approach that you like to pick? So when I go and talk about this foundation, the discipline approach says we stick to the plan. Now, in terms of running, we have well over 100 million pages that we can be dedicated to how and tell you how to run a marathon. The only issue is that none of those websites can actually run the marathon for you. They can tell you how to do it, but they can't do it for you. Well, that's just like investing as well. If there's 170 million pages dedicated to investing, none of them can actually run the race of investing or run the race of retirement for you. So they can't invest for you. They can't do retirement for you. Now, there are some new websites out there that are trying to do just that. Trying to invest for you, trying to help you pick stocks and bonds that are going to be helpful, trying to figure out your diversification. And those websites are brand new, and they're definitely a good place to look at times. The only issue is that those websites fail to address the most prevalent problem that we have as investors, and that is ourselves. So many times do we say, let's move our funds to cash, or let's make this change, And sometimes we don't plan for the outcomes. And that's something that the websites will allow you to do, and they're not going to give you any feedback or sometimes even any pushback or answering of your questions. And that is where I say these websites can run the race with you. And I think of them kind of like a brace, that if you have a brace on, say, your leg, it will be right there every step of the way with you. It will be helping to lift some of the weight of you, but it's not actually going to run the race for you. You still need to run the race. That is the reason why we have a plan in place. And part of that plan is just how we look at our income sources, how we look at our expenses. And in this case, I want to change analogies a little bit. I like to think sometimes of our income like a corporation. So envision with me, as if you will, that you are a corporation. Now, corporations have many different ways that they bring money in. So they have products that they have sold that money is coming in the door. They have vendors that are buying things, so they have different revenue streams coming in the door. The same is true with us. So we have personal savings and investments. We have, say, your employee sponsored plans. We have IRAs, 401ks. Then we have pensions. We have all of these things that make up your income streams. Well, just like an actual corporation, they don't just take that and sit on it. They want to reinvest it. They want to get a return off of their money. And some of that money goes to research and development. They want to put that money to use. They want to work on making that money work for them on future growth of their company and their corporation. Other times, these companies want to say, you know what, let's take some of that money that we have in place and put it to a project that we already know is paying out. We know kind of what to expect from it, and let's build that up just a little bit more so we have much more known conservative growth. Both manners that these corporations go through are correct, and both of them help to sustain themselves for the future. Well, we do the same thing as well. For research, for development, that's just our growth type of investments that we have that are set for the future. Sometimes they pan out really nicely and they're a very, very good place to have in our portfolio, and sometimes they don't. That's the more risky aspects of what a corporation does, is trying to plan for the future with research. And that's still needed because they still need to have that research in the future, the same way we still need to have some growth in the future. Now, good corporations and good planning says we don't just leave it there. We want to make sure that we have something we can come back to, something we can fall back on that's going to be very, very consistent. And so as part of thinking of yourself like a corporation, take time to reflect on who you are, how growth oriented you are, or how conservative you are, and that will really help to figure out more and more some of your needs as well. Now, I just wanted to kind of highlight this. There are many different types of ways that we can have money for retirement. I said before, we have IRAs, 401ks, government plans come into place here. We have Social Security, pensions that we can have. We have annuities. All of these can be our income streams. And while we're still having those income streams come in, and especially working income, we can take that money and save it. So now we can start investing it into something for growth. Just like companies plan for 10 years out, 20, 30 years out, we now as investors can plan for the same timeframes of growth so that we have the amount of money we need available when we retire. That's what we look at here when it comes to all the different retirement aspects. Now, a lot of times I begin to sound like a broken record and talk about things over and over again, and it's for a good reason. It helps that we're reminded of what makes up a good investment strategy And sometimes we do forget or just need that, like I said, little reminder. And this is no different. I want to spend just a moment talking about the reasons why we diversify. And in front of you here, you have this screen that shows what basically the stocks and bonds have done over what we call a rolling 10-year period. And how you read this is that if we would have been invested in 1996 into stocks, over the course of the next decade, we would have actually outperformed bonds. Now, conversely, if you would have started investing in 1997, just 1 year later, we no longer would have outperformed bonds. We would have now had bonds outperform stocks. And you can see there were actually a number of 10-year periods that bonds outperformed stocks. Well, there's also a 10-year period that stocks outperformed bonds. And because of that, this is the exact reason why we have diversification, so that in all times we can try our best to make sure we can reduce our risk and to try for growth when we can have it. So that's the reason for diversification. Now, some of you may look at this and say, bonds look very stable. I really don't care about the stocks anymore. I just want to be invested into bonds. And look, see, they don't go down. There's nothing really different about them. And that is true with some bonds. Now, others can have more risk. And yes, bonds do have risk. And take a look at what I have in front of you here. This is the 20-year Treasury bond that we can get from the government. And what this shows is that over the course of the last number of years, going back to 1995, the yield or the interest and dividends that is paid you has steadily gone down. So we have gone from right around about 7% and very, very well, we've kind of kept that down to about 2% in the last couple of years. Well, what happens is that when interest rates go down, the price of the bond goes up. They have an inverse relationship. Well, the same is also true that if the price is now going down, the yield or the interest that it pays goes up. So we have been in a period of time over the last 20 years that the yield has gone down on what we can be paying you from these types of treasuries, and the price has been going up. Now, that is starting to change, and as the graph shows, from about 2012 onward, we're basically creeping back up. And if this trend continues, you will see bond prices start falling a little bit more. So just be aware that there is some risk with bonds as well. That's not the only place we can diversify, though. Other people say, let's have some cash in our portfolio. Cash is a great thing to have, especially when we're using it for income, if we need to have some on hand for monthly expenses, things like that. But to have all of our money in cash at times can be a bad investment strategy. And to give you an example, as we look at things here, this is what cash pays you today. So many, many years ago, and some of you remember this, when you could put money into a bank or a CD and 5% was easy to get on interest, or maybe even years ago prior to that, in say the 70s and 80s, when you remember a CD paying 13%. Well, that's no longer the case. And today, we were, since 2006, basically at zero for an interest rate from the federal government. And as of yesterday, they raised the interest rates from 0 to 0.25%. So hooray, the worlds are coming together. Now you're going to get a higher interest rate in your bank account. Well, we have raised it very, very slightly, but the rest of the world is still going through this process. And if you remember back to a number of years ago, we called it quantitative easing. And basically that's just saying that the federal government is stepping in and the Federal Reserve is giving banks all of these different avenues to say, go lend money, do not save it. and that's where we've driven our interest rates so low. Well, we're starting to raise them back up, so we're stopping the quantitative easing, but the rest of the world is still going. So China is implementing quantitative easing. Japan has been doing this. They've pumped $1 trillion into their economy over the last year. Europe just did another whole stimulus package about a week and a half ago, and that's to say that we have all these disparities in the economies. I like what we see here. This was from the Wall Street Journal just a couple days ago, and this person is the president of the European Central Bank, and his name is Mario Draghi. And what he said is that there is no particular limit to how we can deploy any of our tools. What that means is that the European Union is going to try to do everything in their power to lend money and to keep their economy from going into a recession and start growing their economy. So that is a complete change from where we're at here in the US, but it also shows that there's opportunities to be had. Now, some see opportunities and others see hardships. And the very same day in the Wall Street Journal, we see this as well. And the title goes, Less Than Zero, Living with Negative Interest Rates. And in Switzerland is what this is highlighting. They're not at zero for an interest rate. They're at a negative interest rate. And the article said, once it's a good thing to have money in the bank, now Danish companies pay taxes early to rid themselves of cash. At one small Swiss bank, customer deposits will shrink by 1/8% a year because basically the bank is taking that money. So it's costing you to keep money in the bank. But then it goes on, it says, it's not all bad. Some Danes with floating rate mortgages are discovering that their banks are paying them every month to borrow instead of charging them interest. Wouldn't you like that, to have the bank pay you to have a mortgage? Well, again, these are things that have really never happened in history, and so we're kind of at a new point in time here, but this highlights kind of where we're coming from and our need for a plan. So let's kind of recap a little bit our needs for a plan. In the phase that we're coming up to retirement, we can see that we need to have a growth plan in place, a way to get us to retirement. In retirement, though, is completely different. Now we're saying, let's start having an income generating bucket. So we have an income phase that we're going to be in. And what this shows is that we're taking about $50,000 every single year out of the accounts, and we need to grow that to keep up with inflation. Well, if we're not growing the accounts, if we don't have the correct plan in place, well, we can really start seeing how that affects those withdrawals affect our overall account balance. But we can also see that if we don't do it correctly, we could run out of money prior to prior to retirement ending. And so what I want to say is that this is the exact reason that you want to have a plan in place. And for those of you on the webinar today that have never had a plan or need a plan reviewed, what we want to do is have a complimentary consultation with you, talk about where you're at, review your plan, and you can sign up for that and have us contact you as part of the evaluation. Just ask for that and we'll contact you and set up a time to meet. But it's very important to have this plan in place because this is the process by which now you can be having more confidence in retirement that your money will last and you're able to pull out the money that you need. I also want to talk about this, and again, I don't mean to sound like a broken record because I know I've talked about this before, but this is the other avenue and kind of piece of the puzzle, that the diversification that we kind of harp on so much. There's a reason why we talk about that, because, and as the study shows, about 91.5% of your returns comes from your allocation and your diversification. And then it's tied to everything else. It makes up just a small portion of the rest. So translation, it's time in the market. It's not timing the market. Time in the market, not timing the market. That's how we have a successful retirement. I want to end with this quote from Warren Buffett: where some see challenges, others see opportunities. You do things when the opportunities come along. I've had periods in my life when I've had a bundle of ideas come along, and I've had a long dry spells. If I get an idea next week, I'll do something. If not, I won't. Start seeing the opportunities that you have in front of you there. We've covered a lot today. We've covered a lot about some of the foundations, and I related that to a marathon and running a marathon, and the marathon that is retirement. So that is, kind of a good thing to do, but when we're talking about this is a marathon. Too often we judge ourselves every 100 yards against the best sprinters in the world. And that gets us worried, that gets us anxious that we're not sticking to it and hearing our plan. Well, that is exactly what we want to do. Diversify. Remember, think of yourself like a corporation and try to look at all the different avenues and aspects of who you are in the plan and have just an income plan in place. And we would love to sit down and help you with that to make sure that we have all the different avenues thought through and taken care of. So if you do have questions, here's our contact information. Please give us a call as you have any questions. And with that, I would like to thank you for attending, and I would like to bring back in Scott Caskey. Scott?
All right. Thank you, Nate. Just briefly want to touch on our next workshop that we have coming up in January. It's the next iteration of our Third Thursdays webinar series. It'll be on tax management strategy, tax matters. It's our normal tax workshop. We will be discussing the 2015 tax information, things to know, as well as the changes coming in the 2016 tax year. Tax planning being a very important part of the overall financial planning process. Thank you again for attending today, and please complete the evaluation form on your exit. Thank you.